right, good morning. How are you guys doing? Excited? All right. Somewhat financial cases and modeling. So welcome. I'm Atif Ikram. I'm going to be teaching you this course. What are you expecting? Financial cases and modeling. What are you hoping to get out of the course?
Real world experience.
Well, real world application I can give you since this is, yeah, I know where you're going with that. Okay, yeah, sure. Yeah, so, anything else?
A lot of Excel.
Yes, you'll certainly get that. So financial cases is basically we're going to try to apply finance knowledge to real world situations, cases, and then the modeling part is where the Excel stuff is going to come in, where I'm going to give you, for the most part, I mean, to be honest, a full-blown financial modeling course would be like a course in itself. So we're going to have a blend of the two. And if I were to be honest with you, it's going to be more geared towards applying knowledge than on Excel. I'm not discounting Excel. Excel is certainly going to be a very important part of this course. But I guess relatively speaking, this is more about you saying, hey, I know present value, I know NPV, I know IRR. Okay, now let's take a situation and try to apply this knowledge. And while I'm doing it, trying to unravel this sort of case that I have, how can I use Excel to do that a little bit more effectively? So this is the gist of the course. What I want to do is just spend maybe about 30 to 35 minutes just going over the course structure in general, how the course is designed, and how you can expect to be evaluated in this course. And in the process, if you have any questions, raise your hand, ask a question anytime, okay? All right, so the way this course is structured is this. I basically have laid it out into 6 main modules. The first module is financial statement analysis and forecasting. As the name suggests, here you're going to be focusing on analyzing financial statements and then using those financial statements to, well, forecast the future, so pro forma, as you will. You're like, oh, easy, I can skip the first week of classes because I already know this. Well, don't do that because as you will see in this course, we'll try to go a little bit deeper into things and you'll be learning, as like I said, I'll provide you a refresher on this and then there will be a case on this. So financial statement analysis and forecasting, that's the first part. The second module is capital budgeting. What is, refresh my memory please, what is capital budgeting? What do we mean by the term capital budgeting? Anyone?
When you use that to equity ratios?
You're thinking capital structure. Yeah. Yes.
To determine what projects or investments to do based off of the rate of return you need.
Yes, yes. So capital budgeting is almost like, so if I were to, oh, and by the way, before I move on, we have one individual who's sort of remotely logged in, and so for the benefit of that person, I will be trying to avoid writing on the board and trying, this is the first time I'm doing this, I'm going to be trying to make use of my tablet and maybe write some stuff here. This might work for the benefit of all of us because I'm going to try, now it will work in your benefit in the sense that you may not have to focus too much on note-taking. I'll try to jot down everything over here and then ideally save it so that then maybe I can send you the annotated presentation files later on. So it might work out for the benefit of all of us. First time trying it, so I will often find myself probably going to the whiteboard and realizing I have to come back. So just bear with me on this, okay? So anyway, the point that I'm trying to make is that if you look at a standard balance sheet, you have assets on the left-hand side and you have debt and you have equity on the right-hand side. Capital budgeting is basically focusing on what assets the firm basically is looking to invest in. So capital budgeting literally means, I have a budget, I have some capital, where should I allocate it? That's capital budgeting. To your point about how much debt and equity, that is exclusively is dealing with the right-hand side of the balance sheet, which is capital structure, which has more to do with, now that I know which assets I want to invest in, where should I get the money from? It's like you've decided that I want to pursue a bachelor's degree in accounting. Okay, so that's the asset that you want to invest in. That's decided. Now the question is, should I go to my uncle to get the money? Should I get a scholarships, try to get a scholarship somewhere? Should I put in my own hard-earned money, or maybe I should get a loan? That's the financing part of it, right? So that's a related but distinct idea. We're going to try and tackle both, right? So capital budgeting is first. That's where we decide, okay, which projects to invest in. Then we're going to talk about a very important idea, which is cost of capital. Again, what do you understand by the term cost of capital? Cost of capital. It's a cost.
If it's debt, the interest rate you're paying?
Sure. Yes and no, as you will see. Yeah, I don't mean to water down your response there. You're right, but be careful, because whenever, this is very important. And again, don't get alarmed if I'm throwing a whole bunch of terms like in the first 10 minutes of class to you. This is just a bird's eye view, right? So we'll go deeper into all of this. But cost, whenever we talk about cost, we're always talking about cost in terms of opportunity cost. Opportunity cost. So whenever you see the term cost of capital, think opportunity cost, and opportunity cost is not necessarily the cost that you're paying right there and then. To put any poker players here? Come on, there's got to be a few, right? Okay, right. So you just won a big pot. You have $500, a bunch of chips, and now you have deuce 7, which is like the worst hand in poker. And you shouldn't play it. Some people do, and they're like, oh, I have so much money. I'm not paying any real cost. I have $500. What, it's $20? $25 that I'm gambling? No. You have to think about opportunity cost. You have to think about what you could have done with that $25 elsewhere with a better hand. So think about cost always in terms of opportunity cost. It's not just what you're paying right there and then. And so we're going to drill deeper into this. Why is this important? And why is it that it is following capital budgeting in this way? Because if you're the financial manager and you've decided, you're thinking about which assets to invest in, well, that money is going to come from somewhere. If I'm the manager, you're the people who are going to give me the money. You're not just going to give me the money just like that. You may be very rich. You're like, oh, here's the money. No, you're going to say, look, Atif, I'm giving you this $2 million, $3 million, but as a result, it's costing me 10% return I could have made elsewhere in a similar investment. So I'm expecting 10% from you, which means that to me, now the cost of those funds is 10%. I have to give you 10% back. So any investment that I'm going to do as a financial manager, the capital that comes with it costs me in terms, what is your required rate of return? The rate of return that you want is basically your opportunity cost, which makes it my cost of capital. I know I threw a whole lot of terms your way. Let me say that one more time. When you are going to give me some funds, saying, yeah, go invest, you are expecting something. So you have some required rate of return. What is that required rate of return? That is always going to be your opportunity cost, which is what you are foregoing somewhere else. If you're foregoing 10% somewhere, then you require me to give you 10%, okay? Which means, therefore, that my cost of that capital is 10%. So required rate of return, opportunity cost, cost of capital, they're all actually the same thing. They're the same. Important because whenever we are evaluating investments, we're going to need to talk about how much that capital is going to cost that we are using to make that investment. So that's the next thing that we're going to talk about. And then once we've talked about that, then we're going to move on to the fourth module, which is capital structure. which is basically now, as I said, focusing on the right-hand side of the balance sheet and asking, how should we finance our investment decisions? It's one thing, okay, so so capital budgeting means we have decided these are the assets to invest in, okay. Cost of capital means that we know that our debt holders want some return and our equity holders want certain return, okay. The question of capital structure very loosely is, how should I structure my financing? In other words, should I focus more on debt and less on equity, or vice versa? Does it even matter? In fact, if you go back to your FIN 302 or FIN 361, you may recall two famous people, Modigliani and Miller, who said it doesn't matter. Capital structure decisions don't matter. Or we're going to talk about that. Again, don't get alarmed. You're like, oh man, Modigliani and Miller, I've forgotten all about those guys. Well, we're going to talk about it. I'm not going to just throw you in the deep right away. Yes?
That was only without like a corporate tax structure.
Yes, absolutely. Yeah. So we'll ask the question, does it matter? And then we'll say under certain circumstances, it does matter. Under certain, it doesn't. You're right. So with corporate taxes, it does matter. So we'll talk about it. 4 modules, you're like, so far so good, seen everything, I can do this. And you're right, you can. But the idea here is that I'm going to refresh your memory, maybe go deeper into these things, but then each module is going to come with its own case. So you're going to have one case that goes with this, financial statement analysis, one case that goes with capital budgeting, one case that goes with cost of capital, one with capital structure, and then we go into slightly more advanced stuff. This is typically where your introductory finance classes stop. Capital structure. We're going to go a little bit further into alternative valuation techniques. Anybody here seen adjusted present value? It's okay. Okay, so just one person? That's fine. That's great, actually, because we're going to talk about it here. So it turns out that, so you walk out of FIN 361 saying, oh, NPV is the best. When in doubt, go with NPV. Well, that's not entirely true. So we'll see why. And we'll also see that NPV is not the best way of going about things certain ways. So it turns out there are some other more advanced discounted cash flow valuation techniques that you can use. Adjusted present value is one of them. There's another method called cash flows to equity. There's another method called capital cash flows. Again, don't worry about it, we'll go there, but the point is that we'll go into these more advanced valuation techniques, and more specifically, I'll show you that especially in the context of private equity and leveraged buyouts, these alternative valuation techniques can come in pretty handy. Anybody? I'm pretty hopeful you've seen, at least heard of leveraged buyouts, but what do you gather from leveraged buyouts? What are leveraged buyouts? Yes.
Just using debt to finance an acquisition.
Predominantly, yes. So leveraged, as the name suggests, means that you're using a lot of leverage, debt, and buyout suggesting that you're buying something. So leveraged buyout, excuse me, is when you're using a lot of debt to make an acquisition. Turns out that in those kind of situations, typically adjusted present valuation techniques, or these more advanced valuation techniques, can be more helpful in valuing the buyout compared to your standard discounted cash flow analysis that you've seen in the past. And then finally, we're going to go into the last module, which is mergers and acquisitions. The leveraged buyout and acquisitions, these are kind of related, as you can see, because even with leveraged buyouts, you're talking about acquisitions. It's just that here, the buyout or acquisition is using a lot of debt, but we're going to talk about mergers and acquisitions and more broadly. Here, you will come across more technical context, as you will see. Right? So this is a quote-unquote the new stuff, if you will. So 6 modules. There's at least one case that goes with all of these. The reason why I say at least one is because for mergers and acquisitions, there are 2 cases we're going to discuss. And with alternative valuations, with leveraged buyouts, we're going to do 2 cases as well. So I'm going to walk you through how those cases will be handled. and how you're going to be evaluated in this course now. Any questions so far? These are the 6 main modules, basically. All right. So how will you be evaluated? There are 5 main things. There's group presentations, class attendance, group case analysis, midterm, and a final exam. So what I want to do is talk about all of these in a little bit detail right now, so that you already know going into the semester as to what's at stake here. So first, class attendance. Class attendance is going to be about 12% of your final of your total grade. The way I intend to do class attendance is this. We can, if this clock is off, I can sort of set it in a way so that it's exactly set right. So at the beginning of class, what I intend to do is take attendance. With 33 students, that can be time consuming. I don't want to spend too much time doing it. So what I'm going to do is that I'm going to develop a seating chart. So there will be a seating chart which will be available to you on Canvas by the end of the first week of classes. So it should be on Canvas by September 1. And I expect you to sit according to the seating chart. There will be, so each table here has 2 chairs to it, and that's how I'm going to go about it. Bottom line is, when you look at the seating chart, just know who your neighbors are. And you don't want to be sitting in someone else's seat, because that could work against you. So I'll make a seating chart. You don't have to worry about formal attendance today. You don't have to worry about formal attendance next class, which is Tuesday as well, because we're in the drop ad period. So I want to let the dust settle first. But then afterwards, the first official attendance will happen basically next Thursday. The seating chart I probably won't get done before September 1st. So here I just might do like a formal roll call, but then going forward it will be seating chart based. I will do, the reason why the seating chart helps is because then towards the beginning of the class, I'll just look at which seat is empty. Towards the end, I also look at which seat is empty, and we're done. So you get 50% points for making it on time and 50% for your endurance till the end. And so that's how you get the full attendance points for each session. Fair enough? Couple of things. You are allowed to miss any 2 sessions, and this is basically to account for all sorts of stuff that happens, job interviews, pre-planned trips, what have you. You are not obligated to explain, because but I mean, if you send me an email, I'd certainly be appreciative of that, but you don't have to, because you are allowed 2 absences without any penalty. Okay, so any 2, and that doesn't include the first 2, which is the drop ad one. So any 2 after. All right, so that's class attendance. Then let's talk about group work. Group work is an integral part of this course. In fact, if I take you back to evaluation, there are 2 types of group works that you will be doing. There is group presentations, and then separately you have group case analysis. Combined, this group work makes up about just shy of 40% of your total grade. So what I want to do first is tell you how this group structure will work. So group work basically involves this. I am giving you the liberty to form your own groups. Right now it shows 33 students. So I want you to make groups of 4. And there will be a total of 8 groups. So 8 groups of 4. One group, if it still remains at 33, one person may end up being in a group of 5. But yeah, I'm not sure how I'm going to deal with that. If all of you end up forming your groups of 4, then I'm going to have to ask one of you to accommodate one other person. That's just how it is. But basically, we're going to have 8 groups total of 4, and then one group of 5, if their enrollment stays at 33. I would like you to form your groups by August 29th. So if you know some people right now, talk to them, make your sort of agreements and whatnot. If you are not part of a group by August 29th, then I'll put you in one. And then the groups will remain unchanged for the duration of the semester. So once the groups are formed, it's done. So form your groups wisely, especially if you know someone who's hardworking or has something to add to the group. Don't do it just well, I mean, friends are sure encouraged. It fosters communication, but still also do it based on how group members are going to work together as well. Once the groups are formed, then all 8 groups will critically analyze Harvard Business School case studies. So I don't know if you've had the chance to take a look at the syllabus in detail, but if you go on to Canvas and then just go and click on the syllabus link over here. So right around here, you'll see this link to the Harvard Business School website, where I have created a course pack for you. This is for purchase. There's some optional reading there, but there are some that are required. The stuff that is required is basically 7. The stuff that is required is basically 7. Actually, I think it's 7 to 8 cases, if I'm not mistaken. I think it's 7 to 8 cases, and so it will show you which stuff is like mandatory and which is optional. So you don't have to buy the optional stuff. Optional stuff is only for those people who feel like their finance background is rusty or they need to brush up on some of the stuff that they learned before. Okay. So these 7 to 8 cases, the way it's going to work is this. These cases broadly correspond to each of the modules. And so, let me see. So let me actually write down the cases that are relevant over here. So one case that is required is called the Clarkson Lumber. So Clarkson Lumber is one case. You don't have to write this down. And maybe I'll just abbreviate these. So Clarkson Lumber refers to the first module in the course, which is financial statement analysis. There's another case called New Heritage Doll Company, abbreviated NHDC. This is the case that goes with the second module. There's a case on Marriott, which is on cost of capital, so which is the third module. There's a case on California Pizza Kitchen. That's the fourth module. And then for the fifth module, which is advanced valuation techniques, I'll just write AVT. There are actually 2 cases. So this is the fifth module, and there are 2 cases that go with it. One is called Sampa video, and the other is called DuPont Performance Coatings. I'm just abbreviating, and again, this is just for illustration. And then finally, the last module is mergers and acquisitions, so mergers. And so this is the 6th module, and again, there are 2 cases that go with this. One is called Dow's bid for Roman Haas, and the other one is it's called Conrail. There's a reason why I'm writing all of this down. So basically, there are Conrail, Dow, California Pizza, DuPont Performance Coatings, Sampa. These are 4 cases which go with modules 5 and 6. So 4, and then 5, 6, 7, 8. So total 8 cases. Total 8. You will be presenting. Oh, I'm sorry. I think I missed one. Sorry. There's one other case called ISS. This also goes with advanced valuation techniques. So 9 cases total. All right, so 9 cases total. These are required, and it shows in the course pack. Okay, so 9 required cases. Now, the reason why I wanted to write all of these down is because this case, Sampa video, and this case, Conrail. So of the 9, these 2. You will, even though you're not going to be required to work on these as a group per se. In other words, you won't be graded on it. You are welcome, nay, encouraged to analyze these cases, but I won't grade you on these. I'm going to be coming to class and presenting these to you, and I expect that you'll sort of follow me and try to make sense of this. So of these 9, these 2 cases you won't get graded on these. I'll present these to you. I'll show you how the working goes. The rest of the seven, you will work on these yourself. Specifically, you will analyze these as a group, and then you will be presenting these as a group as well. So let me first talk about analysis. Are you with me so far? I've not confused you in any way. Any questions? So of the 7 cases, you will be analyzing. What does analysis mean? Analysis basically means that you will be doing Excel work on these cases and then submitting your Excel work through Canvas. So you'll read the case, you'll analyze it, and analysis will mostly be done in Excel. All groups will need to do this. All 8 groups will need to do this. All groups will submit their analysis. What I recommend is that when you submit your Excel work, you annotate your Excel files, which means that write down why you're doing what you're doing, give a little bit explanation so that I can follow, basically your work. Okay, so that's the first thing. I will, for your benefit, post some suggested analysis questions, which are meant to guide your thinking. So when you look at a case, look, how many of you have not had a whole lot of exposure working with cases before? Everyone's worked with some cases, or no cases? Okay, yeah, that's fine. That's totally fine. The reason why I'm saying this or asking you this is because, see, most students that I see up until now, they're used to very structured way of thinking. Here is the WACC formula. Now go calculate WACC. And it's a very clear-cut instructions, just do this and you're done. The thing that you will struggle with in this course is that things will be very open-ended. They will be unstructured. You will read a case and you're like, now what do I do? Where do I start? Where do I go? And so suggested analysis questions are merely sort of guide you in that direction, but please, please, please understand this. Cases are not assignments. It's not like suggested in question 1, this is the answer. Suggested question 2, this is the answer. No. Cases, the way you want to handle cases is when you form your group, think of yourself as like a consulting team. The CEO of the company has created a document for you, says, here's my company, this is what things look like. Please tell me what should I do? And the objective is through your case analysis, you sort of suggest, what should be done, but not by answering these questions, but just sort of take these questions and then sort of give an overall view as to what should be done. So think of yourself as consultants. Don't think of these cases as assignments. Okay, this is very, very important. So that's group case analysis. And then finally, there will be group presentations. There are going to be 8 groups, and there are 7 cases that you will be analyzing, right? 1 case will be analyzed by 2 groups. So basically, each group gets 1 case to present, but 1 case will be allocated to 2 groups, and that case actually happens to be the ISS-AS case. This is perhaps the most complex case of the course, relatively speaking. So this case will be presented by 2 groups. All the others will be presented by 1 distinct group. So basically, this is how the 7 cases will be allocated to the 8 groups. And you will know which case you're going to present. So I will let you know once the groups are formed and everything. By the end of next week, you will know which case you will be presenting, and I will be doing this sort of randomly so that by the end of the next week, you should know which case you will be presenting. Okay? And so mind you that, and I'll take you back, that group case analysis is graded separately and group presentations are graded separately. And the reason, this is very important because this portion is more about presentation. This is more about communication, right? So I have for your benefit, posted, sorry, one more slide. I have posted a grading rubric for presentation. This is on Canvas. Please take a look at it. you will find it useful to take a look at this because this will tell you how you will be evaluated on the presentation. One of my key objectives in this course is this. Some of you may be Excel wizards, some of you may not. So some of you may have good Excel skills and technical skills, but if you can't communicate them effectively, then it's not really that good. Communication is a very, very important skill you need to come out of this, come out with after your undergraduate degree. And my hope is that after this course, you will get some insight into that as well. How do you present your results effectively? So that's what the presentation, the focus on the presentation is all about. I do expect that you will make these presentations formal. So dress up like you would for a formal presentation, and I expect all group members to present at least some portion. So I see some group work rather than one or two people just dominating the entire presentation. So all of this is sort of highlighted in the rubric as well. Any questions so far? Okay. What else? Oh, I have specific deadlines for you, both for group analysis and presentation. So let's take the first case, which is Clarkson Lumber. Okay, let's take the first case, Clarkson Lumber. There will be a set date on which a set group will have to present it. And there will be a set date on which all of the groups will have to submit their case analysis. So the deadlines for analysis submission, that is posted on Canvas. And if you are the group who's presenting it, then one day prior to the presentation, you need to submit your presentation slides on Canvas as well, right? So deadlines for both. So and those are laid out again on Canvas, so it'll be fairly easy for you to follow over there. Group coordination failure usually does happen. You may end up getting stuck with someone or more than one person who is not doing the job. So in case a group comes to me and says, look, this guy or this person is not working, I will first, I recommend that you keep track, have some proof or evidence, some series of mails, something that shows me that this guy is not working. In which case I will issue an email saying, look, this is what has been said. Please do the work. And if the problem continues, then I do reserve the right to take you out of that group, in which case all the subsequent cases you'll have to analyze just by yourself, right? You'll be all alone. Don't want to be in that position. I also reserve the right to lower your score on any previously submitted group work because you really wouldn't have done a whole lot on those, your group members' work. And on top of that, I could, again, give you an additional assignment to compensate you for the lack of work that you did on the previous cases. Bottom line, a lot of work. Don't be in that situation. Just work with your group members, really. It's perfectly fine to say to your group members, look, I'll take more of the workload on this case, analyzing it, but I have to go on a vacation these few days, so why don't you guys do more of work here? And that's totally fine. Just make your group members happy. Group members happy, I'm happy. Okay, so that's totally fine. Finally, midterm and final exam. Because this course is heavy on Excel, there will be some at least some Excel-based stuff on the exam, which means that I am expecting you to bring your laptops and open them up in class and then do some Excel work. So my recommendation here is this: come to each class with your laptop and be ready to work in Excel, because sometimes I'll open up Excel right here and start working in Excel myself. And I want you to follow me, see what I'm doing, ask questions. The Excel portion of the exam, both the midterm and the final will be inspired by the cases that you would have analyzed during the entire course. So what I'm saying here is this: if your Excel is weak, this is an opportunity to make it stronger. And what I don't want you to do is that you say, oh, 3 people in my group are very good at Excel and I'm very good at making presentations. So why don't you guys do the Excel and I'll do the presentations? Look, that will work just fine for group work. And I don't have any problems with that. But if you don't do the actual Excel work yourself while your group members are doing it, you will have a hard time on the exams because I will test you on that stuff that you did on Excel. So typically what's going to happen is we are going to have a case. Someone is going to come up and present it. Then I am going to follow up on that with my analysis, sort of reflect on what has been sent by the presenting groups, and we can have sort of a session going on in which you talk about what you did, I show you what I'm doing, and then we sort of learn. While I'm doing all of that, open up your Excel files and sort of say, okay, I get that. Or this is the mistake that I made. Or, proceed by following all the Excel work that I'm doing in classes as well. Okay, so that's my general recommendation. So to succeed in this course, if your finance concepts are rusty, then I do recommend going back to your FIN 361 textbook. It could be a different textbook. It doesn't really matter. The one that I recommend, it's not required. The one I recommend is Corporate Finance by Ross, Westerfield, Jaffe, and Jordan. This, I think, is the commonly used textbook for FIN 361 here. But you may have seen one by Brealey, Myers, and Allen. I don't know, it depends. The bottom line is take your 361 textbook. I have, like I said, in the course time, there are some optional readings that I've included. So you can take a look at those as well. The way I'll be doing this course is this. I won't just throw you into the deep. The first module is financial statement analysis and forecasting. So I'll start with a review of the very basics. I will move quickly through them, expecting that you know some stuff, but it will serve as a review. And then once we've done the review, then we go into the case. Then we go into the next module. I give you the review, then we do the case. Review, case, and then for the more newer stuff, I spend more time on the concepts and then we get into the cases. Right? So that's how it's structured. I strongly recommend that if you're struggling, see me during or outside office hours. My office hours are going to be Tuesday, Thursday, 1:30 to 2:30. Don't feel compelled or restricted by just those office hours. If you want to see me outside office hours, the only thing that I ask is that you email me so that I can carve out some time. But I'm happy to help you whenever you're struggling, and I strongly recommend that you see me if you're struggling. This will come in particularly handy. Be patient. Patience is a lost virtue these days. Everybody wants to get a six-pack in 1 week. But be patient. Sometimes, things that are worthwhile take time. And so sometimes, especially for the new stuff, you will find that you're like, man, I don't get this. Let's spend some time. It's okay. It will be worth it, right? Sometimes one tiny concept can take you 1 week, but when you're done, trust me, it will help you, right? So be patient. Expect that sometimes learning one small thing can take a lot of time, and that's okay. That's really okay. Tons of resources out there on YouTube and all those also different types of resources. So hustle. I recently created this my YouTube channel. I'm not by any means saying that you have to go there. And to be honest, the stuff on this right now is very basic. So just some very basic stuff on DCF and NPV IRR, and I'm building this over time just because some students asked for it. But again, some of this might be helpful. And then this again, please try to solve all the cases yourself, because come exam time, you will have to do the Excel work yourself. Okay, so this is very important. Finally, this part. Look, this in my experience, and maybe this time it might be different, but in my experience, a lot of students are like, man, it's my senior year. I want to take it easy, and I get that, but this is not going to be a walk in the park. I can tell you that. There's work, but I think it's a very important course in the sense that it is literally, if you have a positive mindset about it, I think it's good training for you for things that are out there. You will be working in teams out there. Most importantly, you won't be given a very structured question by your manager. You will deal with very open-ended situations. What should we do? And you're like, good God, I don't know. And sometimes you'll be asked a question, what do we do? And you're like, I don't even know the basics to even answer that. Sometimes you have to go out there, take the initiative, learn the information, and then start handling questions, make assumptions. You will get training in that, definitely, on all cases. So this is a very, very good training exercise for you. And finally, communicating effectively, again, something very important out there, okay? So if you have a positive mindset about this course, I think that you can end up learning a lot, and I will certainly try my best to do that, okay? So all that belaboring, I know, but I wanted to set the expectations right. Do you have any questions for me? Pretty good? Okay, let's do this. All right, so let's get into the first module then. Financial statement analysis and forecasting. So we are starting out with the very basics in the sense that, you know, if you're the financial manager, before you even start asking the questions like what investment should I make, how do you make good investments? One of the key things that you have to determine about any investment is what can I get out of it? Specifically, what are the cash flows? How do you measure cash flows? Well, you need to have an understanding of revenues. You need to have an understanding of costs. You need to have an understanding of all the different expenditures that happen. And so my point is that before you can even get into any sort of meaningful valuation exercise, you first need to understand the building blocks, which are financial statements. And so financial statements is what we're going to start out with. As you might see over here that the title is broken up into two, is financial statement analysis, and then the second part is forecasting. They're two different things. We are working with financial statements. So first we're going to go over the basic structure of financial statements. Financial statement analysis is basically trying to understand how are we doing today? How do we gauge the financial health of the company today? That's analysis. Financial statement forecasting is about, okay, now that I have an understanding of how I'm doing today, let me see where I'm going. That's more future looking. So forecasting is what's going to come next. So we're going to talk mostly about the balance sheet and the income statement today. Statement of cash flows is important, but we're not going to spend too much time here because most of the stuff that we can do with analysis can be done with balance sheet and income statement. And then finally, we'll talk about forecasting. So let me start out with the very basics. Let's talk about the balance sheet. So let me ask you a question. If you are looking at a balance sheet, and before you start giving me all sorts of like current ratio and quick ratio and leverage ratio and all this ratio and that ratio, before we even start doing that, what are some of the things that you should be cognizant of, some of the things that should be at the back of your mind when you're looking at any balance sheet? In other words, what are some of the defining characteristics of a balance sheet?
Assets versus liabilities.
Yes. Okay. So yeah, very basic, right? But absolutely. So in fact, assets equal to liabilities plus equity, right? So two. So the first thing that you might say is, oh, the balance sheet, one of the fundamental things about a balance sheet is that it has to balance. It's an identity. Assets equals debt, which is liabilities, plus equity. It is going to be useful for you to think of this identity as uses versus sources. Because really what's happening is that if you look at the right-hand side of the balance sheet, this is essentially where the money is coming from. This is sources of cash. This is sources of funds. When you say, oh, I have accounts payable of 455 million, what that really means is that your supplier has extended you some credit, and you're making use of that funding, right? You're making use of those funds that are coming through you, through your supplier. It's a source of funding. Deferred taxes, you've deferred your taxes, but so it's helping you fund some stuff. all types of different stocks, common stock, preferred stock. This is different types of funding. So the right-hand side is simply sources. The left-hand side is simply where those funds are going. So what are they being used for? So it has to be the case that the balance sheet balances because the sources have to equal uses. To take a more fundamental example, right? If we're saying assets are equal to debt plus equity, I mean, one thing that could happen is, let's suppose you're starting out a restaurant and you're like, okay, I'm going to put in $100,000 of my own equity in it, but I don't want to start immediately. Maybe I'll just put it in my business account. So this goes under the asset side of your restaurant, but here it's in the form of cash, right? So sources of funding, which is equity, is purely translating into one type of asset, which is not doing anything right now. It's just cash. Everything balances. Then maybe 1 week later, you're like, okay, I am going to use part of this funding and maybe buy some inventory. Okay, then cash basically goes down to maybe something like 70,000. And now you have inventory that you've just bought, which is basically worth 30,000. So again, balance sheet balances. Right? My main point is that sources have to equal uses, and uses can be, of different types. So that's the first thing. I know, fundamental, but important to bear in mind. Anything else?
Short-term versus long-term debt.
Yes, so I mean, yeah, so your debt can be short-term, long-term. So now you're talking more about how your liabilities or your debt could be composed differently across different firms or maybe even different industries. Fair enough. So some debt could be short-term, some could be long-term. Anything else? So one other, again, perhaps very fundamental, but very important for you to remember, is that the balance sheet is a snapshot. It's a snapshot. It's a snapshot of how things look like at a very specific point in time. It's possible that in your senior year, you were living off of ramen noodles from January to November, and then you were going through internships, taking the buses to all those interviews, and finally on December 25th, you get a letter saying, hey, Mark, we'd love to have you on board. Here's a signing bonus, $50,000. And so if you look at the December end and show your, sort of bank account to your friend, your bank account says $50,000, your friends are like, man, you're rich. And they don't know that for 11 months of that year, you were broke. You were living off of noodles. And that's exactly my point. When you look at cash equivalents of something like 157 million over here, oh, this firm has a lot of cash. But yeah, right now, maybe. But that doesn't tell us anything about how this has fluctuated during the entire year. And that's going to be very, very important. It's going to be very important, especially for something like inventory. You could have a whole lot of inventory right now, but it doesn't tell you how that is fluctuated. And turns out this is going to be very important when you're calculating a very certain set of ratios called turnover ratios. We'll talk about it. Okay, but the other thing is that it's a snapshot. Does that make sense? It's a snapshot, how things look like at a very specific point in time. There's another point that I want to make, which is this. We did say that the balance sheet balances that assets are equal to debt plus equity. But you have to understand that everything on the balance sheet, this identity, this is only in terms of book values. Book values. Everything that you're seeing on the balance sheet is in terms of book values. What does that mean? What does that mean? Book values. Yes.
The cost that you recorded when you actually purchased it.
Yes, so book value, sometimes you will hear the term historical cost. Historical cost, right? So what that really tells you is that, if you want to think about it in this way, balance sheet is basically showing you sort of historically what has happened. The reason why this is important is this. Let me do this. So let's suppose that you start out a catering business. Okay, I'm keeping it very simple. And so you start out a catering business and you put in equity of say $100,000, and you maybe buy a van, which is worth $100,000. Okay, so this is a van. So again, this is not realistic, but it'll get the idea across. Maybe you start operating this van. You operate this van for 20 years, running around doing your catering. What do you think is going to happen to the value of this van over time on the balance sheet? It's going to depreciate, right? So typically you see this van as like property, plant, and equipment. But then you have something like accumulated depreciation, which is how over time this is depreciated. And so over the course of the next 20 years, the accumulated depreciation may very well be 100,000. You've run this van to the ground basically, so that on the books, it's worth nothing, which might actually basically tell you that on the books, even the 100,000 that you put in is now owning an asset which is worth nothing. So your equity is worth nothing on the books. But what if there's someone out there who's like, man, I'm into buying antique catering vans. I don't know, art collector or whatnot, right? And this guy says, oh, great van. Oh, you served in the Hollywood area? Even better. I want to pay you $800,000 for this van. That value is not reflected on the balance sheet. That's a market value. And this is very, very important. Ultimately, as the person who's running this operation, I don't care as much about book value as I care about market value. It's not what the assets are worth on the books, it's how much people are willing to pay for those assets in the market. That ultimately drives the values of the assets, which therefore ultimately drives the value of my equity, right? So so just like you have a balance sheet identity, which is in terms of book values, that assets equals debt plus equity, we normally see this in terms of book value. Well, what I want to impose upon you is that there's a similar balance sheet identity that you can think of. Let this term V represent the value, the market value of the assets. And what I'm saying to you is that this should be equal to the market value of debt and the market value of equity. I'm using slightly different symbols here. I'm using the symbol B here for market value of debt because in the market, the form of debt that trades the most is bonds. So B is basically bonds. And the S is for stock, which is the equity that is traded in the market. And so this, you can think of this balance sheet identity also holding in market value terms. And again, this is kind of loose, but the main idea is the crucial thing here. And ultimately, this is more important. And unfortunately, your standard balance sheet doesn't tell you anything about any of this. This comes from the market. Okay, so this is again very important. Does that make sense? There's one other thing. On the balance sheet, we see that the assets are usually listed in the order of liquidity. What does that mean? What is liquidity? What do we mean when we say assets are liquid? Yes.
How quickly they can be turned into cash.
How quickly they can be converted into cash, right? We say that asset is liquid when it can be converted into cash rather fast. Let me ask you a question. Let's suppose that I have $1 million house in Scottsdale, and you know I'm off the mood. I go on Craigslist. I say, okay. I go on Craigslist. I say, selling a house in Scottsdale, 5 bedrooms, a pool, you know, granite and all that, selling for $50,000. How soon do you think I'll be able to sell that house? Pretty soon. I post the ad and boom, the next minute Tom calls and says, stay right there, I'm coming to you, I have the cash right there and then. Here's my question. Was I able to convert my asset into cash pretty quickly? Does that make my house liquid? Is it a liquid asset? I was able to get my asset into cash pretty fast. The answer is no. Liquidity is how quickly you can get your asset converted into cash without a significant loss of value. The second part is very important because guess what? If the price is right, you can convert any asset into cash pretty quickly. The price just needs to be low enough. It's not just about that. It's about without a significant loss of value. Now, I know you might say, well, what do you mean by significant? And yeah, it's kind of subjective, but main point is that you should be able to sell it very close to its market value. So there's a reason cash and cash equivalents, cash equivalents you might recall from your FIN 361, this includes like securities, like treasuries, marketable securities. There's a reason why they're right at the top, because you can get them converted into cash and get exactly their market value at the time, right? And so that's basically why these are listed in this order. Inventory, again, if you wanted to sell it, you could sell it very close to their market value as well. So this is very, very important. Liquidity has two parts to it: how quickly you can convert an asset into cash without a significant loss of value. Okay, so bear that in mind. Cash and cash equivalents is one portion of the balance sheet that I want to talk to you about a little bit more. So usually when you look at a balance sheet, you'll see like cash and cash equivalents. This is basically cash lying around doing most of the time doing nothing. It's just lying around. So this is typically, or at least a major portion of this is just excess cash. It is excess in the sense that it is not doing anything to facilitate the operations. Okay, one more time. It is excess in the sense that it is not doing anything to facilitate any of the ongoing operations, which is why we say that excess cash is an example of a non-operating asset. So on the left-hand side, I know that you are used to seeing, where did my status go? Right here. Yeah, you're used to seeing the balance sheet represented as like this. All right, you have assets here, and then you say, okay, some of the assets are current and some are fixed. I mean, basically, this is the dichotomy that you're used to. I'm saying there is another way that you can think about assets as well. Just like assets can be current versus fixed, assets can be operating versus non-operating. So operating assets are basically any assets that are helping operations. These could be, so inventory, well, it's related to operations. Your furniture, your tables, your chairs, and all that part of operations, right? So don't feel like only fixed assets are operating assets. No, some fixed assets, some current assets, most of these will be operating, but excess cash or cash in general is an example of non-operating asset because it's just lying around in a bank doing nothing. Why is that important? Why is that important? Because when you encounter a question like, what is the worth of this firm? Or what is the worth of this business? You have to think about value of operating assets separately and value of non-operating assets separately. Maybe this will help. Maybe this example will help. Let's suppose that there's a house. So a house, 5 bedrooms, and let's suppose that the worth of that house is 500,000 in the market. Let's suppose. Now, this 500,000 value is driven by the fact that there is a certain set of structure to this house. It has 5 beds. So the worth of this house of 500,000 is being driven by these specific sort of the way the bedrooms are there and all that. So think of the beds as like the operating assets in a way. This is what's making the house work. let's suppose you decide to sell this house and you're like, okay, I'm selling this house, but now there's a catch in the basement. And there's a basement to this house as well. Oh, and by the way, in the basement, I have dug up like, or I've sort of saved like $100,000 and I'm selling the house with it. I'm selling the house with it. There's an excess cash that's lying around. How much do you think will I be able to fetch for this house now? If I want to sell this house, will I only be able to sell it for 500,000, or will people be like, well, there's 100,000 in the basement. So the rational conclusion would be people would be willing to pay 600,000 because they'll be like, here's 600,000, then I'm going to go to the basement, dig up the 100,000. My point is this: the value of the house, which is being driven by the operating assets, that's still 500,000. You can't say that the worth of the house is 600,000. You are valuing two separate things. And so this is very important, because when you will later on encounter situations where there is one firm looking to buy out another firm, and they will have some operating assets and then some excess cash lying around, then you'll have to value the operating assets separately and the excess parts separately to figure out how much is the total. But you may have seen a term called enterprise value. Have you seen that term before? Right. So enterprise value. Enterprise value, and we will see this many times later on as well. You may have seen that it is the value of equity plus the value of debt. And then what happens? What do you do? We'll again, if you don't remember, you might, and I will talk about it, but you typically end up subtracting excess cash from this. Again, if you go back to 361, we say enterprise value is basically the value of equity plus the value of debt, and then you end up subtracting excess cash. Why is that? Because you're sort of doing this sort of an exercise where you're like, look, I don't really care about the non-operating asset. What I really care about is what I'm paying for the house net of the excess cash, because that I can just get hold of anyway. So my point is this. This is very important. This is a punchline. When we talk about enterprise value in this way, enterprise value is nothing but the value of the firm's operating assets. Because something like non-operating asset like excess cash is being filtered out, just like we did here in the example of this house. Okay, so enterprise value is a very specific meaning. It is the value of the firm's operating assets only. I'm not saying excess cash is irrelevant, but you should know what enterprise value is capturing. Ultimately, you will pay 600,000 for this house, but you are paying 500 for the operating portion of it. Okay, so that's the idea. So we are more concerned with this guy. We're always more concerned with this guy, enterprise value. There are some other types of non-operating assets as well, but I don't want to spend too much time on that. What I want to do is talk a little bit more about, well, before I do that, so this is what has happened, just to give you some insight into what's happening in the real world. When the financial crisis happened, right about like 2008, since then, firms were stockpiling their cash because they were like, interest rates are rather low, so let's take cheap debt. And plus, a lot of these firms, like your Apples and all, they had a lot of this excess cash in foreign countries. And so they were reluctant to bring them back because they had to pay a very high tax rate on that. But after 2017, things have changed because something has happened. The Jobs Act, it has basically, among other things, it has lowered the tax rate that corporations have to pay on their overseas excess reserves. And so what this is showing you is that since 2017, which is after the Jobs Act, excess cash on the firm's balance sheets is actually reduced, because now firms are actually bringing that back, paying out dividends, buying back stock, and making capital investments with that money. So just wanted to give you a sense for what's happening to excess cash in the US right now. What I want to do is talk very quickly about some other sort of non-traditional assets that you see on the balance sheet. One type of fixed asset that you will see on the balance sheet, which is an intangible one, is patents. And here's something interesting. I don't know if you are aware of this, but the way patents are treated, you will only see patents on the balance sheet if they were acquired. In other words, if I am a pharmaceutical firm like Johnson & Johnson and I go, oh, this are the young firm, they have got these patents for God knows what, I'll just go ahead and buy this firm out. When I buy that firm out, all the patents that they own, they end up going on my balance sheet. So that's what happens when I acquire a patent. You might be surprised to know that if I were Johnson & Johnson and if I were working on that same patent myself using my own labs and my R&D, all that money would actually end up getting expensed, so that those patents never end up showing on the balance sheet. All of them gets expensed. So there's something to be wary of when you're looking at patents, because guess what? Here's what happens. A company which is pursuing an innovation strategy which is based on acquisitions, acquiring patents, that will end up appearing more profitable. Why? Because you're not expensing any of that stuff, right? So your expenses are low. And it will also appear asset richer because all of those patents are getting reflected on the balance sheet, compared to another firm which is very similar, has similar patents, but it's developing them internally, right? So just something to be wary of when you're looking at, if you're looking at two pharmaceutical companies and you're like, these guys have much lower net income and fewer assets. Why is that? They must not be doing a good job. Well, it depends on their patent acquisition strategy. Okay, so be wary of that. The other thing that I want to talk to you very quickly about is goodwill. What is goodwill? That's another form of an asset that you can have on the balance sheet. Yes.
It's like the price you pay over the book value for a company.
Yes, correct. So it's like a balancing item. So when one firm buys out another firm, you may end up paying more than the book value of the assets. And that's more likely to happen because you end up paying the market value, or sometimes even more. We'll talk about that. But so goodwill is a balancing item, and so it reflects the difference between the book value of assets that you're acquiring and the market value, or the amount that you're paying. And this is important because sometimes you will see cases in which you will have firms which will have very high goodwill, and typically what firms have to do is that they have to revisit the amount of goodwill and revise it upwards or downwards depending on what's happening in the market. And so it is very possible that I bought out a firm, paid like 100 million when the assets on the books were only 50 million, and then next year I go and like, oh shoot, I think I overpaid, and then you have to revise your goodwill downwards. So you have to take on impairment charges. So all that. So we'll see a case on that as well. And the other thing to remember is this: when you're buying out another firm and have this goodwill getting recorded, it's like buying a long-term asset, right? Because you're buying a firm, which means that you, just like any fixed asset, you have depreciation. So just like that, if you're recording goodwill, then goodwill gets amortized over time. So you will see some goodwill amortization on the income statement as well as a result of this. So again, just giving you sort of a preview of some advanced stuff that is going to come later in the case, in one of the cases. Any questions so far? Are we okay? The one other thing, which is very, very important, I want you to be this is one thing that I want you to be familiar with. Just like I've just talked to you about some like non-standard assets, there can be some non-standard long-term liabilities as well. I won't talk about a whole lot, there are several, but perhaps the most important one is leases. Lease is a long-term liability. There are two types of leases. What are they? There are two types of leases. Maybe I'll write here. There are capital leases versus operating. Does anybody know the difference? What is the difference between a capital lease versus, like, so if I lease a car, if we understand that, right? I'm leasing a car. Depending on whether it is a capital lease or an operating lease, things could be different. What is the main difference? Yes.
Leasing to own versus just leasing just to use it.
Yes. Same thing? Yeah. So in a capital lease, if I lease a car, at the end of the lease term, I own the car. Okay, the car transfers to me. Okay. In an operating lease, I am leasing the car, I operate it, and then I give it back. So when you go lease a car from like a dealership, you're basically doing an operating lease. You lease the car, use it for 2-3 years, and then you give it back. Okay, operating lease. Okay. As you can appreciate, whether it's a capital lease or whether it is an operating lease, what happens when you lease a car? Basically, you have become indebted. You have financial obligations towards someone, right? Instead of an operating lease to a dealership, then you are obligated to make payments. Okay. Now here's the thing. This is very important. If you're not aware of this, this is crucial for you to know. Previously, when firms had operating leases, those operating leases would not show up on the balance sheet. You would say these are operating expenses, and these would appear as off balance sheet items. In other words, I have just taken like a car, right? I'm using it. The expense, so the payments that I'm making, I would just end up expensing that, and it won't show up on my balance sheet because the idea was that, hey, I'm not going to own that asset, so I'm not really paying for any asset per se, so it's an expense. But if you think about it, whether it's a capital lease or an operating lease, at the end of the day, there is a financial obligation. You're obligated to make payments. That sounds like debt, right? That sounds like debt. And so very recently, as recently as post December 15, 2018, companies are now required to do the following. They are required to calculate the present value of their lease payments for operating leases and then record that as debt on the balance sheet. It's no longer just expense. You are becoming indebted. Doesn't matter whether it's an operating lease or sort of about that, but public companies are required to report operating leases on their balance sheets for fiscal years that begin after 2018. Why is this a big deal? It's a big deal. Why? As we know, when you go out to take a mortgage, for example, among other things, what the bank is going to require to disclose is, have you got a student loan? Do you have financial obligations elsewhere? How indebted are you right now? And so if just because of an accounting change, if previously you were like, oh, I'm not that indebted, I have a bunch of operating leases, all of a sudden, 1 year to the next, you are indebted, which means this will hinder your ability as a company to get debt. And what I want to show you actually is one company, so I'll let you read this article yourself, but one company that is facing problems right now because of this is WeWorks. WeWorks, as you may know, is a company which rents out like this office space for people to work in. But guess what they do? They enter into this long-term lease to get a building, right? Previously, it was operating leases, so it wouldn't show up as debt. Now, all of a sudden, it's debt, right? And so as they're nearing their IPO, people are like, well, you are very indebted. And they're like, well, that's strange. Last year, we weren't. Well, because the accounting rules have changed, right? And so this can have an impact on the IPO price that they can fetch in the market. And what is particularly worrisome now is that this is brought to attention, at least to the investors, is this. WeWorks is entering into long-term leases to get these buildings, and their tenants are short-term. It's people like you and me who just work for 1 year, 6 months, move out. This spells trouble, because if your obligations are long-term, but your source of revenue is short-term, there's a mismatch. Anytime, any downturn happens and all of a sudden people stop renting space, you're in trouble, right? You can become now you can technically become financially distressed because you have too much debt on the balance sheet, okay? So anyway, I think we're good for today. So thank you, and we'll pick it up next time. I strongly recommend that you start working among yourselves to start forming your groups right now.
I remember like coming together with a random group of people like that before when we were all just like desperate. So we all just kind of were like, I don't know who you are. Let's
So long story short, I'm in Barrett and I need to maintain like a full course schedule to maintain my scholarship essentially. So I was ahead and I was going to defend my thesis in the spring, but I wasn't going to have it. So I ended up adding an econ. And I course called options analysis and forecasting. It's econ 14.
It's a great course.
Are you familiar with it?
I mean, judging from the title, I think it could be a very useful course.
Yeah, so I was going to ask what your opinion on it was. I know we're going to do a good amount of like forecasting and analysis in this class, but I don't know what the difference between that and econ 14 is.
Oh, that one is much more advanced.
Okay.
Regression analysis is, sorry, just give me 1 second.
You're good, no worries. I don't need to take
No, it's perfectly fine.
Maybe it's a question for my counselor.
No, I can, I'm happy to.